Hello, my name is Kanwal Sarai, and welcome to the Simply Investing webinar. I'm very excited today. We've got people from all over the world listening in, at least over 7 different countries that I can see right now on the list here. So I'm very excited to be offering this webinar today. So let's get started. What's in it for you? In today's webinar, you're going to learn some of the fundamentals to successful investing. The goal is to show you how to maximize your profits, make more money, and at the same time minimize your risk. The focus is going to be on creating a new stream of income, of passive income, and we're going to see very short how you can set that up and get going. Specifically today, we're going to be covering 4 rules to successful investing, and again, these are designed to help you earn more, save time, and reduce your risk. Here's the agenda for today's webinar. We'll start with a little quick introduction about myself, get into some of the investing myths. We'll look at the basics first, and then we'll get right into the 4 rules, and then chat a little bit about mutual funds, and we will have some time at the end to get to some of your questions. About me, Kanwal Sarai. Now there's a couple of places where you can get some more information about myself. One is going to be on the Simply Investing website. If you go to simplyinvesting.com, click on the About right at the top from the main navigation bar, and you'll get some information about me. The other option is also you could watch Module 1. This is the complete Module 1 of the Simply Investing course, and that again is available on my website. And the last URL is a little bit long here, but we'll leave it up on the screen for a few seconds. This is a blog entry I did recently, and it's a little bit about myself and how I got started investing on my own, so you'll find that very interesting. So today I don't want to repeat any of this information. A lot of this information about my background and how I got started is available on our website. We want to get into this webinar and get going quickly, so I've got one slide here, and this should take about 60 seconds or less. A little bit about me. So I first started investing in 1988, beginning with a term deposit, or a GIC. I then moved on to mutual funds, ETFs, and then stocks. I had mutual funds for about 10 years, working with different financial advisors and financial planners. I realized over the course of 10 years the mutual funds would go up and down in value. Towards the end of the 10 years, I had nothing to show for it. The value had dropped. I came to realize that financial planners, advisors, at the end of the day, were mutual fund salespeople. And sometimes their interests don't align with my interests as an investor. In any case, then I got involved in 1998 and 99 in the high-tech bubble, where all these high-tech stocks were going up through the roof. Stock prices were increasing almost daily. You could literally buy a stock for $25, $30 on a Monday and sell it on a Friday for $40, $50. So I got involved in buying stocks without any knowledge of what I was doing, just going after advice from family and friends and what I read on the internet, and that didn't go so well either. I wasn't making money with stocks. I wasn't making any money with mutual funds. So I realized that I had to do something different. I had to educate myself first and get some knowledge and learn on how to invest properly. So I had to find some role models, people who didn't win the lottery or inherit any money or had rich parents, but who became successful on their own, and who were successful consistently over the long term, year after year after year. So basically find out who they were and just copy what they did. So I read a number of books, did lots of research, and the same concepts kept coming back over and over again, which was essentially you have to invest by yourself, for yourself. No one cares more about your money than you do, and it is very simple and easy to invest on your own. And that's what I started doing, and you can see the track record on our website, which covers the last 10 years, is available. And I was very successful at it, and I continue to be successful. So this webinar today and the complete Simply Investing course is accumulation of, I spent 3 years researching this through trial and error, interviewing other investors. So the webinar and the course everything that I've done all packaged into one to make it very easy for you to get started and become a successful investor. Okay, let's start with some of the investing myths. There's three big ones that most people think of. The first thing they think of when you tell them that you are going to be investing on your own, or you tell them you're going to be investing in the stock market or buying stocks. So what are some of the negative connotations around that? What are the things that people think of? First one is people are going to say, well, it's risky. It's like gambling. And people use terms like, oh, well, you're going to invest in the market. You're just playing with your money, or you're taking a chance. And you'll see shortly as we get into this, into the webinar, that it doesn't have to be risky at all. The next thing is people think it's time consuming, that you're going to have to spend hours and hours of research on learning how to invest, and hours of research on which stocks to buy, and then tracking them every day, and that is not the case. My students are very busy. People who have taken the Simply Investing course, they have kids, they have full-time jobs, and they can do this. Essentially, the way we go about it in the complete Simply Investing course is we describe what I call a plan A and a plan B. Plan A does take time, and it is better suited for individuals, people who do want to spend the time and do the research and do it on their own. And that takes about approximately, an hour, 30 minutes, maybe an hour and a half, a month, or whenever you're ready to buy stocks, when you have money to invest. So plan B is a lot quicker. It's about 10-15 minutes a month, or only when you're ready to buy stocks, when you have money to invest. That's when you would use plan B. It is quicker. Both plan A and plan B will give you the same results, and in the Simply Investing course we go through both options in detail. And one of the last things I have here on the list in terms of the investing myths is people think it's too complicated. They think it's like rocket science. And that's not true. You don't need a master's degree in finance or economics or accounting in order to be a successful investor. Now, the financial industry wants you to think that it's complicated so they can take your money and invest it on your behalf. But it doesn't have to be complicated. So investing is risky, complicated, and time-consuming if you don't know what you're doing. And that's the bottom line here, is education. And that's the difference between someone who's investing responsibly and someone who's just speculating and buying stocks and hoping just on sheer luck that they're going to be good at it and make lots of money. Next, let's take a look at some of the basics. Some of you may already be familiar with some of the topics in this section, but I do want to make sure that we're all on the same page. What is a stock? A stock is basically an ownership in a company. For example, Microsoft has a little over 8.7 billion shares outstanding. So if you wanted to buy half of the company, you would have to buy a little over 4.3 billion shares. If you bought all 8.7 billion shares, you would own the company. So most cases, people are not going to be buying that many shares. So if you were to buy 10 shares or even 100 shares, you would have ownership of the company, albeit a very small piece of the company. So when I talk about stocks or shares, in our context, it means exactly the same thing. It is an ownership, part ownership of a company. This is what a share looks like. An example for Starbucks Corporation. These days, you don't have any shares, physical shares they can hold on to. It's all electronic. So when you do buy and sell shares, it's all done electronically. So this is kind of rare to be able to see what a stock certificate looks like. A lot of times when people talk about investing in shares or stocks, they think of it as a piece of paper. So this is what you see on your screen is a piece of paper. It is a share of one share in this company. But I want you to stop thinking about investing in a piece of paper. It is an ownership of a company. So it's sort of a mental shift in thinking. When we talk about investing, we talk about taking part ownership of a company. So as an investor, that's what you're doing, is buying a little piece of the company. Now as part owner of the company, you're entitled to two things. One, you'll be invited to the shareholders meeting every year, which most people, in the last 12 years, I've never gone to an annual shareholders meeting. Most people don't need to go or attend unless you've got millions and millions of dollars worth of shares. The second thing you're entitled to is to share in the profits, because you're part owner of the company. You're entitled to profits. Which brings us to the next question. What is a dividend? A dividend is basically a cash payment that is made out to you as a shareholder. It's essentially you're sharing the profits of the company. So in this example, let's say we've got a company that is giving out $1 dividend per share, and you happen to own 100 shares. This means that you will get $100 in cash every year as long as you own those shares and as long as the company continues to pay out $1 a dividend per share. We're going to get a little bit more into dividends further in the webinar, but this is extremely powerful. It doesn't seem like a lot of money right now, $1 per share, but just hang in there. In a few minutes we're going to be taking a look at how powerful dividends can be. And the last question is, what is the stock market? And this is what most people think of when they hear the word stock market. This is an actual photograph of the New York Stock Exchange, and you see people, whenever you see it on TV, there's people running around with pieces of paper in their hands and shouting orders back and forth. Basically, a stock market is a place to buy and sell shares. Now, because of the internet, we can do it from the comfort of our own home, and we don't have to go out to the stock market to buy and sell shares. We can do it online. The two major ones that we talk about is the New York Stock Exchange. That is the largest stock market in the world, and also in Canada we have the Toronto Stock Exchange. So Canadian companies, for example, like Petro-Canada or Loblaws or Canadian Tire, trade on the Toronto Stock Exchange, and then the American companies, for example, like Walmart, Starbucks, McDonald's, trade on the New York Stock Exchange. So how do you become a successful investor? What's the big secret? And it's basically no secret at all as soon as I show you what it is. But this is the essence of everything that we teach at the Simply Investing course, and the essence of what we're going to be teaching today in the webinar. How do you become a successful investor? You become a successful investor by buying quality stocks when they are undervalued. The two key things here are quality stocks and undervalued. Let's take a look at undervalued first. So on your screen you can see a graph of a stock price. When the stock is priced at $14 a share, it's undervalued. When it's at $51 a share, it's overvalued. Stock prices go up and down for many, many reasons, and they fluctuate. They're volatile. You can always see them. They go up and down at any point. The key here is you want to be able to buy, in this example, the shares in this company when they're at $14, or maybe even $15, or maybe $13 a share. That would be a good price because they're going to be undervalued. Why do you want to buy stocks when they're undervalued? Because that is going to maximize your profits. You buy it at 14 and you can sell it at 51. There's no point in buying it at $51 or at $49 or $52 because there's not much room to make any profit. I mean, it would take years or decades for the price to go higher. So you want to buy low and sell high because that's when you're going to maximize your profits. How do you know when a stock is a quality stock and when it's undervalued? To help you determine that, I've created what I call the 12 rules of Simply Investing. Now in the complete Simply Investing course, the full course, we go through the 12 rules in detail, and we provide you with a step-by-step checklist to help you determine when a stock is a quality stock and when it's undervalued, so you know exactly when to buy. Today we're going to be covering 4 rules out of the 12. These rules lay the groundwork and provide you with a solid foundation to begin investing successfully. So there's no shortcuts here. We're going to go through the 4 rules exactly as we cover them in the complete Simply Investing course. The first rule: will people still be using this product or service in 20 years? So before you consider any stock or share for purchase, you want to think about this for a moment. Whatever company you're thinking of buying and whatever they're producing, will people still be using it 20 years from now? If the answer is no, or maybe, or I think so, then don't buy this stock. Okay, I don't care if your colleagues at work or family members, your brother or sister is telling you this is going to be the hottest stock, it's going to triple in value in the next 6 months. If you can't answer this question or satisfy this rule, then do not invest your hard-earned cash into this company. So what are some of the things that people will still be using 20 years from now? People will still need mortgages, still need to buy homes, financial services, food is another one. And it's kind of funny, I was teaching this class in Montreal a few years ago and somebody raised their hand and they said, clothes. And it's true, people are still going to need clothes 20 years from now. What we're trying to avoid here are fads or sort of the latest fashion or gadgets that people are interested in, because I don't know if they're still going to be in demand 20 years from now. And so you don't want to be investing in those because they're higher risk. You want to invest in things that are certain and that it's going to reduce your risk. The next rule is the company recession proof. Now think about this for a moment. If you were to lose your job, or the economy was down, or there was a recession, would you go out and buy a new car? Would you go on vacation overseas? Or buy expensive items or luxury items at all? Of course not. You're not going to buy a new car, you're going to keep the one you have, and you're going to keep it running longer and just maintain it. Or you start taking the bus. In terms of vacation overseas, you're probably going to go on vacation locally, within driving distance. You're not going to spend money on airfare and hotels when you don't have a job or potential for being laid off and losing your job. So right away that knocks off companies like car manufacturers, aircraft manufacturers, tourism companies. Those companies are not recession proof. When the economy goes down, when there's a recession, people are losing their jobs, they're not going to be buying those items. So you do not want to invest in those companies. No one knows when the recession is going to happen or the next one's going to occur or how long it's going to last. So you don't want to invest in those companies because your investments will go down. However, we do know of some of the things that are recession proof, right? What's the first thing you do when you come home at night? You turn the lights on, right? What do you do in the winter or when it gets cold? You turn the heat up. Even when people lose their jobs, they're still going to need to brush their teeth, they're still going to need toilet paper, they're still going to need, as I mentioned, electricity, oil for heating your home. They're still going to need those things. So those are the companies you want to invest in, the ones that are recession proof, because again, that's going to minimize your risk. The next rule, has the company had consistent dividend growth? So before we answer this rule, I'm going to take a couple of slides to talk about dividends and the importance of dividends. Okay, what's so great about dividends? At the end of the day, it's money in your pocket. It's cash. You're earning money while you sleep when you're earning dividends. Okay, there's no staff to manage. For example, if you owned your own business, there's no tenants to chase after for the rent if you were involved in real estate investing, or there's no tenants calling you in the middle of the night to complain about a leaky toilet. Okay, once you've bought the stock, just sit back and collect the dividends. Okay, and this is huge importance. I mean, some people have stopped working because they collect enough dividends each year. And one of the more famous examples is Derek Foster, who retired at the age of 34, and he lives off of his dividends. Let's take a look at a concept called dividend yield. So the dividend yield is quite simple. It's the dividend divided by the share price. So in this example, we have a company that is paying $1 a dividend per share, and the share price today, let's say, happens to be $10 a share. So the dividend yield is going to be 10%. So let's say you bought 200 shares at $10 each, so you spent $2,000. So your investment was $2,000 in buying shares in company XYZ. If the dividend yield is 10%, 10% of 2,000 is $200. So this means you will receive $200 cash every single year for as long as you own those shares and as long as the company continues to pay $1 a dividend per share. So the dividend yield is basically telling you what is the return on your investment. Here are some sample dividends today. Coca-Cola is $1.88 per share, and we've got Walmart in there, Starbucks, and Microsoft. Now some people are going to look at this and say, well, this is peanuts. I mean, 52 cents per share, it's nothing. You know, I can't retire off this money. I'm not even have enough money to spend on the things that I want to buy. The important concept here that most people miss is that over time, dividends increase. So this is very important. This is another one of those investing secrets that most people are not aware of. Over time, dividends increase. So it may not sound like a lot. You know, you're earning 10 cents a dividend or 15 cents a dividend, but over time they do increase. Let's take a look at the first example again. So the dividend is $1 per share, and the share price was $10. And let's say you bought 200 shares, right? So you're going to get 10% return on your investment. So in the first year you'll get $200. Let's say in the second year the dividend goes up. So now you're collecting $240 in dividends. Year 3, dividends go up 30 cents. And then year 4 they go up again, and year 5 they go up again. So take a look at that table in the very last column, the fourth column. You started collecting $200 in dividends in the first year, and by the 5th year you're collecting $420. Okay, now take a look at the third column, which is the dividend yield. So the dividend yield based on the original purchase price was 10%, and now by the 5th year you're earning 21%. So this is very important. Over time, dividends do increase, and you can generate a lot of money. Here's a personal example of mine. In 2000, I bought 185 shares of TransCanada Pipeline at $13.40 each. This means I spent $2,479. That was my initial investment to buy the 185 shares. Ever since I've owned those shares, TransCanada Pipeline has increased the dividend every single year. So I started off in 2000 earning 80 cents per share. That was the dividend. Today, the dividend is $1.68. So again, if you look at that table in the very last column on the right, the third column, and look all the way down, you will see that the dividend yield based on the original purchase price, today I am earning 12.5% on $2,479. That was my initial investment. I can't get 12.5% anywhere. A term deposit or a GIC is going to pay maybe 2.5, maybe 3%. How much does a savings account pay today? Is it 0.1 or less than 1%? So 12.5% is a really good return. And again, now I just sit back and collect the dividends. There is no maintenance to do, there's no people to call, there's no other work involved. There was the work involved back in 2000 when I did the research and decided to buy TransCanada Pipeline, and I put the order in online, which takes literally 3 to 4 minutes, and that was it. And it gets even better now. Let's take a look. The total amount of dividends received since 2000 is $2,382.76. The total amount of dividends that I've received is almost equal to the initial investment that I made. So when I first bought the shares in 2000, what was my risk? The worst thing that could have happened is the company could have gone bankrupt. Now, it was highly unlikely. It was and still is one of the largest companies in Canada, a market leader in their industry. They've been around for a very, very, very long time. But nevertheless, the risk at the time was that I could have lost all of my money, $2,479, if the company went bankrupt. The risk today is only $96 because I've received $2,382 in dividends. So today, if the company was to go bankrupt, well, I would lose $96. By next year, my risk will be zero, because by next year I will have received enough dividends to cover my initial investment. So the stock price as of October 19, 2011 was $43, which represents a return of a little over 224% increase. Including dividends, the return is 314.4%. And the dividend yield based on the original purchase price is 12.5%. So remember, I purchased these shares when they were $13.40. Today they're trading at $43.49. Do I care if the stock price drops to $30 tomorrow? Or even $20? Or even $15? No, because I'm still making money. And I'm earning 12.5% cash every year on this investment. So this is the ultimate goal, is to have every stock in your portfolio get into this situation where it's returning a dividend yield in the double digits and you've received enough dividends over the years to cover your initial investment. So this is very powerful, and it does require some foresight. If you can think, 5, 6, 7, 10, 15 years ahead that you're going to be needing X amount of dollars or X amount of income coming into the future, you have to make those decisions today, those investment decisions today, so that in the future you will have that income stream coming in. Okay, one last example. This is another real life story. This is a gentleman by the name of Tom Connolly in Kingston, Ontario. This is his example of Bank of Montreal shares. In 1985, he purchased 400 shares of Bank of Montreal. The dividend at the time was 25 cents. So the dividend yield at the time was 4.24%. And his total investment was $9,250. In 1993, the bank decided to do a 2-for-1 stock split. For those of you who are not aware, a 2-for-1 split basically means that you end up with double the amount of shares. Now the stock price does come down accordingly because now you have double the quantity, but I've seen in my experience that over time the stock price creeps back up again, which is great for investors. So in 1993, Tom Connolly ended up with 800 shares of Bank of Montreal. In 2001 they did another stock split, so he ended up with 1,600 shares of Bank of Montreal. Since then, the dividends have increased every single year. So as of last year, the dividend was $2.80. So the dividend yield based on the original purchase price is now 48.44%. 48.44% of $9,250 is $4,480.70. That is the amount of dividends he receives every year in cash that's deposited into his trading account, and that is huge. The other thing to consider is the stocks today. His $9,000 investment is worth over $100,000. Let's take a look at dividend risk. Now, people are going to say, well, dividends are not guaranteed, and that is true. Companies are under no legal obligation to pay you any dividends, even if you are the shareholder. Companies can reduce the dividend or eliminate it altogether at any time, especially if things go bad, if there's a recession, there's layoffs happening, the company is losing money, they can reduce or eliminate the dividend at any time. So dividends are not guaranteed. However, what you have to consider is the history of some of these companies who have been paying dividends for many, many, many years. That's going to help us to determine whether or not the risk to dividends is worth considering or not. Like, how real is the risk? Is it really going to hurt you as an investor? So let's take a look here. Is a list of companies that have been increasing dividends for the last 25 years consecutively. Okay, so that's a big list. You've got 26 companies on the list. You may recognize some of the names. Coca-Cola is there. Johnson & Johnson is there. General Electric is on that list. So this is a list of companies that have increased their dividend every single year for the last 25 years. They did not miss 1 year. If they did, they would not be on this list. What's even more surprising are some of these other companies I've highlighted. Johnson & Johnson has been increasing the dividend for more than 46 years consecutively, because I know they increased it again this year, so we're at 47 years. Coca-Cola, same thing, 46 years. Again, this year it went up, so we're at 47 consecutive years. Emerson Electric, 51 years. And here's another list. We've got lots more companies here, and the one I've highlighted is Procter & Gamble, which has had 54 years of consecutive dividend increases. So yes, the dividend is not guaranteed. Companies can limit it any time. Nobody knows what's going to happen in the future. I can't predict the future with any of these companies on the list. However, when I look at this list, I can have a very high degree of confidence that, for example, Procter & Gamble will continue to pay a dividend next year and increase it, because they have done so for the last 54 years. Worst case scenario, they would probably keep it the same. But the likelihood of them eliminating the dividend or decreasing it is very, 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 very low. Here are some Canadian companies. Here are companies that have been paying dividends for 100 years or more. So that's going to be on the left-hand side of the screen there. It's important to note that Toronto Dominion Bank, TD Bank, has not missed a dividend since 1857. And the other one, the Canadian Imperial Bank of Commerce, CIBC, has not missed a dividend since 1868. So that is very impressive. On the right-hand side of the screen are a list of companies that have been paying dividends for more than 50 years. And again, you may recognize some of these names. Canadian Tire is on that list. Maple Leaf Foods, TELUS is on that list. Here's a list of companies that have been paying dividends for 25 years or more. So when you look at this list of companies, this should give you some reassurance that dividends, especially from these companies, will continue to be paid out. And you don't have to be worried about these companies eliminating their dividend or reducing their dividend. It may happen, but then again, when we build a portfolio of stocks, we're not just buying one single stock in there. We do have other stocks in there who will continue to hopefully increase dividends year after year. So let's revisit the rule that we left off with. Has the company had consistent dividend growth? If the answer is no, then that is a company we're not interested in buying, and you should not be investing your money in that company. Let's take a look at company A. So here's a little graph. Those little dots represent dividends, and you can see over time, as you read the graph from left to right, you can see the dividends gone down. So the amount of dividends the company pays out has gone down year after year after year after year. This is not a company that we are interested in investing in, because this is showing me that next year they're going to decrease the dividend again or eliminate it altogether. Company B, you can see the dots are all over the place. The dividend goes up, then it goes down, then the dividend is eliminated altogether, then it comes back up again. Company B is completely random. We have no confidence as to whether the dividends are going to go up or the dividends are going to go down. So this is another company we're not interested in. Company C is what we like to see. We like to see a steady increase of dividends year after year after year after year. Because we're trying to build a stream of passive income. And you want the income to keep coming in after year, and you want the income to keep growing year after year. So company C is something that we would be interested in investing in. Okay, here's the next rule. Is the company undervalued? Okay, you've all heard the phrase buy low, sell high. You want to buy when the company is low. Okay, remember our statement in the beginning? Buy quality stocks when they're undervalued. So if we look at our stock price graph again, you want to buy the stock at $14 or maybe $15 or $13. And that's where you're going to maximize your profit, because then you can turn around and sell it when it gets to $51 or $50. You don't want to buy it at $51 or $50 because you're not going to make any money off of it. So to help us understand when a stock is undervalued or when it's priced low, we're going to cover this concept called high dividend yield. So this is very, very important. This is the entire Simply Investing course is based on this concept and on this rule, is the high dividend yield. So I do want you to focus on this. So if you are watching TV on the side, or you're sending an email, or you're on Facebook, you do really need to sit down for this slide, to sit down and focus on the next couple of minutes here of high dividend yield, because this is going to let you know when a stock is undervalued, when you should be buying the stock. Now remember, we looked at the dividend yield, which is the dividend divided by the share price. So the dividend is 10%. Now let's say in this example, our company XYZ, let's say somebody, some financial expert goes on TV on CNN and says, oh, I think a recession is coming, or a double dip recession is coming, or the credit crisis, or whatever negative news. I sound a little sarcastic, but I mean, the media likes to sell bad news. Bad news sells. Sells ratings, it sells newspapers, increases ratings, and sells advertising space. So in any case, and we see this happen all the time. Somebody gets on the media, on television, on the internet, and says, it's over, the economy is over. So in this case, what happens to company XYZ is their share price, a week from now, drops to $5. What happens to the dividend yield? You see, the yield has gone up. It's now 20%. So was it better to buy company XYZ today when it's at $10 a share, or would it be better to buy it next week when it's $5 a share? Right? It's better to buy the company when it's $5 a share, because you're going to be able to buy more shares. So a $1,000 investment today would give you $100 in dividends every year. A $1,000 investment next week in the same company would give you $200 in dividends every year. Okay, so this is what I call the law of dividend yield. This is very important. When the share price drops, the dividend yield goes up. And that's the example that we just talked about. Okay, this is important, so I'm going to repeat it again. When the share price drops, the dividend yield goes up. And the opposite is true, so when the share price goes up, the yield is going to go down. So you want to buy a stock when the yield is up, correct? Because you're going to make more money. Do you want to make 10% return, or do you want to make 20% return in this example? Right? You want to make 20% return. So if you want to make 20% return, you're going to have to buy the shares when they're low. Remember, buy low and then sell high. Buy when they're undervalued. So when the share price drops, the yield goes up. So here's an example of, again, company XYZ. Stock prices go up and down all the time. If you were to know the average dividend yield for this example, let's say I told you the average dividend yield was 4.5%. Okay, you can get this information from a number of online resources, or you can calculate the value yourself. So in this example, the average dividend yield is 4.5% for this stock. When the current dividend yield is higher than the average yield, the stock may be undervalued. So let's take a look. So if we look at this stock today, you look up the share price on Yahoo Finance or MSNmoney.com. There's a whole bunch of websites that you can just put in the stock symbol, and it'll tell you what the stock price is, and it will tell you what the dividend yield is today. So if today the current dividend yield is 9% and the average is 4.5%, 9% is higher than 4.5%. So then we make the determination that the stock is undervalued. The stock is priced low. When the current yield is, let's say, 2%, then the stock is priced high. You don't want to buy it when the yield is at 2%. You want to buy it when the yield is at 9%. So I'm not sure if you can see this on your screen, but it's sort of the blue area that we've highlighted below the dotted line. So the area below the dotted line is your buying area. That's when the stock is going to be, historically, it's going to be undervalued. So if you know what the average yield is, then you can know whether or not to buy a stock or to skip, or to wait till the stock price drops, and then the yield is going to go up again. So the statement at the bottom, I'm going to repeat it again because it is important. When the current dividend yield is higher than the average dividend yield, the stock may be undervalued. Okay, so this rule is very important. You want to buy stocks when they're undervalued. This is the one rule that I don't negotiate on. If you're looking at any stock, any company, McDonald's, Starbucks, Canadian Tire, Petro-Canada, any stock, take a look at its current yield. If it is higher than the average yield, then continue further and look at the rest of the rules. And this is a stock that you may want to consider buying. But if the current yield is less than the average, move on. Move on to the next stock. This is a stock that is not the right time to purchase it. Okay, so that's very important. So now we've covered all of the 4 rules that we wanted to cover. The next section up is mutual funds. Because people will come back and say, all this is nice and fine, but I still feel comfortable buying mutual funds. I want to leave it to the experts. So before we start, actually, let's have everybody on the same page. What are mutual funds? Basically, they pool money from lots of different people, and they invest that money into stocks. So that's what a mutual fund is. So when you go out and buy mutual funds, and I go, or anybody goes out and buy them, I wouldn't buy them, but if other people did, all that money would be pooled together into one account, and the fund manager is responsible for buying and selling stocks, and that's all they're doing. So people do say, well, I'm going to leave it up to the fund manager. They're the experts, they're the professionals, they're going to do a good job at investing my money. That isn't necessarily true. So let's take a look at the 5 reasons why mutual funds fail. Okay, there's a whole bunch of them on the list here. We're going to go through them one by one, so you don't need to sort of worry about all that text on the screen. So the first one is fees, especially high fees. Most people are not even aware of this. Mutual funds, it's sort of like a hidden fee, have what they call an MER, a management expense ratio. The average MER in Canada is 2.2%. Unfortunately, in Canada, we pay some of the highest MERs anywhere in the world. So I'll give you an example. So if you get a statement at the end of the year saying that, here's the mutual funds that you own, the performance last year was 5%. In reality, the fund actually did 7.2%. Okay, so they've deducted 2.2%, which is their management expense ratio. So they will deduct that right off the top, and then the statement will say your fund performed at 5% this year. Let's say you get a statement and it says your fund did minus 3.2. Okay, in reality, the fund only dropped by 1%. The mutual fund company, again, took their 2.2%. So the mutual fund company will always make money, whether or not you make money or you don't make money, because they will always take out their 2.2% fee right off the top. Now, this doesn't sound like a lot. People say, well, it's only 2%, or some mutual funds have a MER of 1.75, and it doesn't sound like a very big number. But let's take a look at this. $1,000 invested in the stock market 50 years ago today would be worth over $500,000. With a fee of 2.2%, you would only be left with $193,000. Okay, this is huge. $321,000 would have been lost to fees. And that is a staggering amount of money to pay just for fees. Here's another example. It's a little closer. People think 50 years, they say, well, that's a very long time. So let's take a look at this. $10,000 with a rate of return, let's say, of 10% annually, in 25 years would be worth $108,000, right? If you had a management fee of 0. And when you tack on the fees, you can see that your mutual funds are worth less and less and less. Let's take an example here of a typical fund where the MER is 1.5%. Now that's being generous, because the average MER in Canada is 2.2. But let's take 1.5% here. Over 25 years, $34,100 would be lost to fees. With the same $10,000 invested in 4 stocks, and that all depends, that could be 2 stocks, or, we took 4 as an example. Over 25 years, the amount lost to fees would be $79.92. Okay, now that's not a typo. That is $79 versus $34,000. That is a very large amount of money to lose to fees. The stocks is very simple to calculate the fees. Most trading account places, either banks or other institutions that allow you to buy and sell stocks, the trading fee is typically $9.99. So when you buy shares, pay a flat rate of $9.99. When you sell, there's a flat rate of $9.99. So what I did here is I took an example of buying 4 stocks, right? So that would come out to like $40. And at the end of 25 years, you sell the 4 stocks, and that comes out, it's another $40. So it's $79 total lost to fees versus $34,100 lost to fees. Most people have mutual funds where the MER is greater than 1.5%, so you're losing even more than that. So over your lifetime, you are spending a lot of money in fees. Reason number 2, early redemption by mutual fund owners. So what happens in this example is when the let's say the stock market is crashing or there's a recession, stock prices are going down. When stock prices go down, mutual funds go down because they are essentially buying stocks. What happens is people get nervous, they get scared, they call their mutual fund company and they want their money back. At that point, the fund manager has no choice but to sell the stocks so that he can give the cash back to the investors. This is detrimental to you. Let's say if you're in it for the long term, you know that the markets go up and down, you know that stock prices go up and down, and you know that over the long term you'll do fine. The stock market has done very well over the long term, and you decide to keep your money in the mutual funds, but everyone else is calling their fund manager asking for their money back. This is detrimental to you because as a whole, the entire mutual fund, the portfolio, drops in value because the fund manager has no choice but to sell the stocks. Even if you've got a fund manager who is very smart, they know what they're doing, they know that these stocks are undervalued, they should not be selling them right now. They know that if you just hang on to them for another 18 months, maybe another 22 months or something like that, the stock prices are going to go back up again. But the fund manager has no choice. Their hands are tied. When people are calling and they want their money back, the fund manager has to sell stocks even at a loss. And that is detrimental to the performance of your mutual funds. Reason number 3, short-term focus instead of long-term gain. Most mutual fund companies, they operate the same way. They have a 12-month focus. Fund manager performance reviews are all done once a year. Bonuses are done annually. And that's really their focus. As a fund manager, if you can sell a stock today and lock in 8% return, which is not bad, and you know that this is going to help your performance review, it's going to help you get that bonus, you're probably more likely to sell the stock. Even though you may know that if you hang on to it for another 16, 18 months, 22 months, you may end up with 12% return. But why take that risk? Why hold on to that stock for another 2 years for a 12, 15% return when you can guarantee you can sell it today and make 8%? Right? You may not even, as a fund manager, you may not even be working at the same place 2 years from now. So there is a short-term sort of focus. They're interested in selling quickly. In Canada, the RSP season starts in February, beginning of the year. And again, mutual fund companies want to lock in the returns, show the returns on their brochures, on the internet, on advertising in the paper. Say, hey, we did 9% last year, or our fund did 8.2% last year. And they can put all that into their promotional and marketing material to try and get more investors for the next RSP season. Whereas if you're investing on your own, you have a long-term focus. You've bought a stock that it's undervalued. You know that if you hang on to it, the dividends increase year after year after year. Pretty soon you could be earning double-digit returns just from dividends alone. You can control when you're going to sell the stocks. You don't have anybody forcing you like a fund manager would be forced to sell stocks. Let's take a look at this example for the next reason number 4. Imagine this is your mutual fund portfolio. The first year you made 4.2%, then you made 5.1%. Things look like they're going pretty good. You're making good money. And then in 2009 there's a negative 28.3%. So what happened? The mutual fund was doing so well. The returns were coming in. Everything was great. What happened in 2009 for it to drop like that? Now these are sort of fictional numbers that we've got on the chart here, but this represents true cases where this has happened to mutual fund investors. And what's happened is a good fund manager has been lured away to another mutual fund company. There's very, very few good mutual fund managers out there in the world. You could probably count them on one hand. And the ones that are very good are in high demand. And they're constantly being offered a job at another institution, at another bank, or another mutual fund company, and they're moving around. So you as a mutual fund investor have no way of knowing that your fund manager just left the job and is now working someplace else. Okay, mutual fund companies don't want to advertise that fact that they've just lost their star manager. So the only hint you're going to get is at the end of the year when you get your statement and you realize, whoa, what happened here? Why did I lose so much money all of a sudden? Things were going so well for the last 6, 7, 8, 9 years, and now what happened? And what some people try and do is they will actually, if they find out, the fund manager has changed, they've gone to a different place, they try and sell their mutual funds and then move the money into another institution. Now this is exactly the wrong time to sell, is when prices are down. So you want to be careful. I just want to bring up a point here. It just reminded me, the stock market is the only place in the world where people actually buy more when stock prices are going up and sell when stock prices are going down. Anything else in life, whether it's food, clothing, electronics, or anything, you wait for things to go on sale. And when they do, that's when you buy more and you stock up on it. And then when prices go up, you say, well, I'm going to wait. I'm going to wait for it to go on sale and then buy it. But in the stock market, people get greedy. When stock prices are going up, people get greedy. They think they're going to make a quick buck and they start buying stocks. And when prices are going down, people panic and they don't want to lose their money and they start selling their stocks. And that's exactly the wrong time to sell, is when prices are down. So in this example, if you were to sell when everything was down, the only thing you've done is you've solidified your losses. And then when you move your money over to the next mutual fund company where the star manager is now working at, and if he or she has done a good job, the performance of their funds has crept up, and now you're buying them when they're high again, and that's the wrong time to buy. And the last reason here, reason number 5, historically the majority of mutual funds have underperformed the stock market. So there's tons and tons of books written on this topic here. Different books have different sort of numbers, but what I've found is since the beginning of, the last 85, 90 years stock market history, the stock market has returned an average annual compounded rate of return of around 10%. So over the long term, you should be making approximately about 10%. And if you're not, then you're losing money, because you could have easily put that money into an index fund. An index fund is a mutual fund. Works a little differently. There's no fund manager who's buying and selling stocks. It's just a computer program who buys a whole bunch of stocks. For example, the S&P 500 index fund would have the top 500 companies in the US, and it would invest in that. And the only time it would sell is if a company in that list was removed and replaced by another company. Then the computer for the index fund would sell those shares and buy the new ones. So index mutual funds do a very good job of tracking the stock market performance. Again, so getting back to this reason number 5, a number of books written on the topic, and some mention as high as 85 to 90% of mutual funds in the world underperform the stock market. So that is huge. In summary, you want to buy quality companies when they are undervalued. And dividends are very, very important, especially increasing dividends, because that is going to increase the amount of money you receive year after year after year after year. And investing is not risky if you know what you're doing. Okay, we minimize that risk by investing in recession-proof companies with solid products or services that are going to be around for 20 years or more. And we invest in companies that have a history of increasing dividends year after year after year. So what are the next steps? The next steps would be to take the complete Simply Investing course, where we cover all of the 12 rules of Simply Investing. The course is split up into 5 modules, and they cover everything you need to know to start investing right away. There is a Simply Investing workbook that's included, and a step-by-step checklist that covers the 12 rules, so you know exactly when to buy. More importantly, also to know when to sell. So we talk about that in the course. We also cover all of the risks involved in investing. How do we minimize all of those risks when it comes to investing? And how do you create a portfolio? How do you go about buying stocks? So all of that is covered. The 5 modules take a little over 2.5 hours to complete, but you can do the course at your own pace. So there's no deadline. You can repeat any of the modules, or you can repeat the entire course at any time. So we do give you lifetime access to the course, and it's available online 24 hours a day, 7 days a week. There's 3 packages that are available. The basic package gives you the complete course. The value package, again, you get the complete course, plus you get lifetime membership to the members only forum. The forum is a great place to ask questions. There's a lot of investors on the forum. Some of them are expert, been doing this for many, many years. We've got some beginners in there. So it's a way for everyone to learn from one another, also to ask questions. So I'm on the forum all the time. The other great thing is, once a month I do publish a list of 10 undervalued US companies and 10 undervalued Canadian companies. once a month to the members only forum. So be careful. It's not a buy list. I still encourage you, and I highly recommend. You still have to go through the 12 rules, but it gives you a starting point. It gives you stocks that you can begin to look at. So that's all on the online members forum. The premium package, you get the complete Simply Investing course, lifetime access to the course, lifetime access to the members only forum, and a 60-minute phone consultation with me to go over any specifics, your specific portfolio if you're trying to construct, whatever your specific situation happens to be. So I'm available for that. I'm also available for any other consultations that you may require. We can either do them over the phone or via email to discuss in detail your specific situation to cover that. The course itself does cover everything from start to finish. So we give you everything you need to start being a successful investor from day one. The link at the bottom left-hand corner there, simplyinvesting.com/course outline, will have lots more information on our website. So I want to thank you for taking the time out of your busy lives to attend the Simply Investing webinar today. I hope it was very useful, and I've given you a lot of information that you can use to become a successful investor. So we do have some time for questions now. I'm going to do my best to answer them. If we do run out of time, you can email me questions. My email address is at the bottom left-hand side of the screen, and I'll try and get back to you as soon as possible. Now, I just want to mention before I get into some of the questions, please do keep in touch. There's lots of ways to keep in touch with me. The blog is one spot, Twitter, Facebook, and obviously our website. So you can use any of those ways to get in touch. I'd be more than happy to get in touch with you and answer any questions you may have. Okay, let's get to the questions. The first one up is, what do you think of index funds? Now, I touched on index funds a little bit in the webinar. The only problem I have with index funds is that I don't know when they're undervalued, because they're investing in so many different stocks that you may get some stocks that are undervalued, but you're also inadvertently buying stocks that are overvalued, because you don't have control over which stocks the fund manager is going to buy. In the case of index funds, it's probably a computer that's got an index of stocks that it's putting the money into. So that's the only issue I have with index funds. I think the Simply Investing approach is a lot better, and in my experience, I've done quite well in the approach of buying quality stocks when they're undervalued. So buying index funds, putting money into index funds, you don't know when the fund is undervalued or if all of the stocks that are in that index are undervalued. And they're not going to be. At any given point in time, even during a recession, there's some stocks that are undervalued and there's some stocks that are overvalued. That's why I'm not a very big fan of index funds, but they are certainly better than buying sort of the actively managed mutual funds, because like we said, the majority of mutual funds underperform the stock market. So at least an index fund is going to give you the stock market's performance over the long term. Here's another question. Someone is saying, I'm asking, I'm saving up to buy a house in 2 to 3 years. Can I put that money into stocks? And the answer to that is no. Not just stocks, but even mutual funds. If you're saving money to buy a house in 2 to 3 years, or saving money for a car that you want to buy next year, or to go on vacation in 18 months, do not put that money into stocks or mutual funds, because mutual funds are just turning around buying stocks anyway. This is a long-term strategy. It's not a get-rich-quick scheme, so you're not going to be a millionaire overnight, and you're not going to make lots of money overnight. It takes time. It takes time for stock prices to go up gradually, and it takes time for dividends to increase. They increase, some of the companies increase every year, but they're doing it 10 cents here, 15 cents here. It's not a whole lot of money, so over time is when it's going to make the big difference. In the short term, stock prices go up and down. So let's say you've put in $20,000 and you're thinking that in 24 months you're going to take that money out because you're going to buy a house. But in 24 months, let's say that $20,000 is now worth $16,000. Then what are you going to do? You're not going to be able to buy the house. it's only worth 16. You were hoping they would have had $20,000 in there or more, and then you're stuck. So you don't want to be in a position where you get stuck and you're forced to sell, because who knows 24 months from now, are we going to be in another recession? Our stock price is going to go down even more, and then when you sell low, that's the worst time to sell. So you don't want to put yourself into that position. So investing for the long term, for your retirement, that's a good place to put money in stocks. Or what I recommend is 5 to 10 years. So if this is money that you don't need in 5 to 10 years, then that money can go into stocks, and that's how you should be investing. But definitely do not put money in stocks for anything less than that. Anything less than 5 years, I would recommend you do not put that money in stocks. Better to keep it in a term deposit or a GIC. At least that way your capital is guaranteed and your interest rate is guaranteed. You know exactly what to get at the end of the 1 year or 2 year term deposit. So we got another question here. It says, what if I have questions after I've completed the Simply Investing course? So that's not a problem. Most times we use the forum, the members only forum, answer questions that people may have. So the forum is the best place to go to if you do have any questions. We do cover a lot of questions and answers that we receive from people over the years. That's all been built into the course, and the Simply Investing workbook covers a lot of the material. But if you do find that you get stuck, the members only forum is a very good resource to go to help you move along. Okay, so here's another question. Why do I need the Simply Investing course? Can't I just apply the 4 rules and buy Coca-Cola shares? Okay, that's a very good question. We do cover a lot of other things in the complete Simply Investing course that we have not covered in the webinar. So for example, how do you know when to sell a stock? That's just as important as to know when to buy a stock. So that's covered in the Simply Investing course. How do you build a portfolio? Well, diversified portfolio of stocks. So that's covered in the Simply Investing course as well. And then we go through all of the risks, and we talk about how to minimize each and every one of those risks when it comes to investing in stocks on your own. So you definitely do need the Simply Investing course. What I've given you today is a very good foundation. We've laid the groundwork for becoming a successful investor, but you do need the course to go through the 12 rules. You need to go through the 12 rules, step-by-step checklist, and then determine whether or not you want to buy shares and even Coca-Cola, whether or not they're worth buying or not at this point in time. So here's a question. Someone's asking whether or not I do one-on-one consulting and if the course is available in person. So the first part, yes, the one-on-one consulting, I am available for that. We can do consultations over the phone or in person if you're in the Ottawa area here in Canada. As for his classes in person, not yet. I don't have anything scheduled for next year as well. We've put the course online to make it easy for people to view the course and do the course from the comfort of their own home. And it makes it available 24 hours a day, 7 days a week, and it's lifetime access. So a lot of people appreciate that. We were teaching this course in the past in person, but I mean, then when you're done with it, it's about a 3-hour course, and then that's it. There's aside from the Simply Investing workbook, it isn't very easy to go back and look over the what did I talk about and what did I say. So right now there's nothing scheduled in the near future. But one-on-one consultations, yes, we can do that. So send me an email, let me know what you're looking for, and we can take it from there. Okay, I can see that we're just about done with our time for the webinar. So I want to thank everyone again for attending today's webinar. If there's any questions that we didn't get a chance to get to just yet, please feel free to send me an email, and we'll do our best to answer the questions there. Thank you.